Hey everyone, this is John Feneck with the Feneck Commodities Report. With me today is Don Durrett from goldstockdata.com. Don, how's it going today?
Good. Seems like it's been a long time since our last interview. It's been more than 30 days, it seems like.
Yeah, well, we're trying to do them once per month, and that got a little funky. I think we did one in early June, and now it's late July. So our next one is going to be late August. So we'll keep it
Oh,
going, and not sure who that's going to be yet. But today we've got a really good one. We've got Shaun Heinrichs, CEO of 1911 Gold, joining us in about 25 minutes. So um, I know you and Larry like that stock, and it'll be interesting to hear from him.
yeah. Well, I was the one that told Larry about it. I found it first. I followed it for a long time. When it came in, when it became 1911 gold, I was all over it then. I've been a fan of it from day one, because we'll talk about it. The reasons why I've been a fan of it, but it's all
Sure.
about gold in the ground, location, and CapEx, and just checking all the boxes.
Yeah, absolutely. You and I have been doing this for a little over a year now on YouTube, and we do have those boxes to check, right? And some of these companies do check them all, and some of them don't. And it really does matter, to check most of them, if not all of them. So awesome to have him here. And let's kick it off on the macro side. There's obviously a lot to talk about since June. It seems like in the U.S. alone, there's been so much crazy news with the assassination attempt, followed by Biden stepping down for the race, for a re-up, and then also Harris getting involved and raising $81 million in her first day and a half. So, what do you make of all this, and how do you think it's going to unfold as we get into the fall, which you and I have both been saying for quite some time now that we're going to see some volatility, and now I think we're going to see more volatility.
Yeah, so I'll use the Hugh Hendry line. I recommend that you panic because Q4 is going to be crazy, I think. I think it's going to be very volatile. I think the selling is starting now. So we have the S&P, the all-time high was 56.69. Today we're at 54.31. So we're 238 points away from the all-time high in the S&P. And I've been waiting for when the S&P stops going up. I think we might be there now. We'll see. The David Hunter thesis is that we're just going to keep going up, 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 up. They're going to lower rates in September, and then the markets are going to come back again. I'm not in that camp. I think that we could be, topping out here, and once we top out, I think all of the negative macro data is kind of show up, if you will,
Mhm.
because Wall Street, they only focus on GDP, which is positive, unemployment 4.1, but I think on Friday it's going to go to 4.2, and it's been trending up. The low is 3.4. So 3.4, I mean, 4.3 is probably, once we get to 4.3, we're probably going to be in a recessionary period. So they're focusing on that. The other thing they're focusing on is the stock market. So the stock market's good, but I just told you the number on the S&P. It's down about 5%. So they're just hoping that this is, we got a normal correction is kind of what they're saying. And then they're talking about this rotation trade. They say it's positive, but I don't think it's positive. I think everybody else needs to catch up. We don't need a rotation. They need to catch up, right? Rotation means somebody's getting hurt. And I mean, Nvidia is down 25% from its top. This is a huge week for earnings. Um, I, I could be wrong, but maybe I'm being too pessimistic. The other thing that they focus on is a rate cut. I mean, those are really the only four things they focus on. They ignore everything else. But the PMIs have been negative. Services went negative, which isn't good. Consumer confidence is in recessionary areas. The banking system has not improved. They're having problems all over the place, delinquencies in credit cards, delinquencies in autos. They're not having a great time selling houses. I mean, if you sell houses or you sell cars, so these sectors are, everything seems to be pointing to a recession, but everybody seems in Wall Street seems to be in denial. They're talking about everything's fine. We're gonna have a soft landing. I'm not feeling it. I'm feeling that Q4 is going to be extremely problematic is my take on it. And we're talking about gold and silver here. We got time, but just on the overall macro, I'm very bearish. Um, I just think that we're heading into a recession. The only question is how fast it arrives. Is
Right.
it slowly going to it? But I don't see anyway. The final point that I'll make is that the inverted yield curve, we don't go into recessions until they revert. In other words, the inversion goes the other way and we revert higher or disinvert. That is starting, and that is when
Yep.
the recession begins. The recession doesn't happen when you have an inverted yield curve. That's not when the recession arrives. It arrives when it goes the other way, which is starting to happen.
Yep. Yeah. You and I talked about that last week, and one of our peers, Tabby Costa from Crescat, had tweeted that out as well. I think just to echo a lot of what you just said, we're going to see a tough time here. In that, I don't agree with I forget the name of the guy you just mentioned that's calling for. Sorry.
David Hunter.
Yeah,
David
Hunter,
Hunter.
right. Yeah, I don't see that scenario playing out where we get more fuel based on a cut that everyone and their mother already knows about. I mean, honestly, I don't understand that at all. I think that's completely baked in at this point. Everyone knows that we're getting a cut at some point this fall. So I think it's a sell event for the market, and it might be even a sell event for gold and silver at that point. It's not necessarily a positive unless Powell really lays out a game plan, I think, for future cuts. That's what the market wants, right? They want to see, okay, yeah, we've already talked about September for months now. Let's hear what you've got to say about maybe a December cut followed by a Q1 cut, right? Like we want to see a pattern develop here, and it's still pretty murky. And I don't think we're going to get too much clarity tomorrow, July 31st. We're recording this a day before the Fed. I don't think Powell's going to show his hand very much. We've got Jackson Hole, don't forget, coming up in August. So I think he's going to wait for any surprises there, as opposed to tomorrow, because that's just typically how it works, right? If you look back at history, 2016, we had an amazing rally in mining stocks from January to August. What derailed it? It was the Fed at Jackson Hole. So you as an investor, I think you always have to pay attention to that.
Well, I think the Fed is very misleading um, on their true objectives, if you will. Because if we go back to 2008, when they basically adopted MMT, where they basically said we're going to use debt as kind of our primary tool, if you will,
Mm-hmm.
to basically generate GDP. We're going to use debt to generate GDP, and then we'll use inflation as a corollary. That was basically adopting MMT. And they did it, I believe, under the auspices of basically managing the economy. So
Mm-hmm.
they did, the Hank Paulson bailouts, where they injected, like $700 billion just to start, right? That was the first one, and they did some
Mm-hmm.
more as well. And then the Fed got involved as well. They also kind of for the first time used their balance sheet to help private companies, not
Mm-hmm.
banks. That was a shift in the economic policy, and they've never really publicly acknowledged that. They act as if that never happened. They just keep the twin pillars of full employment and controlling inflation. That's all we're doing, right?
Mm-hmm.
Uh, they never talk about that shift, and I think that shift was dramatic, if you will, and that's why Yellen said when she was the head of the Fed, she said that chairman of the Fed, she said that in my lifetime we'll never have another economic crisis. And the reason she said it is because we're managing this boat now.
Yeah.
And that worked fine. And she said this prior to COVID. That worked fine until COVID appeared. And then, which she never thought would happen, right? She never expected COVID. And then COVID necessitated this massive money printing. And the massive money printing created inflation. Now, suddenly, The Fed is behind the eight ball, and everybody's is kind of ignoring it, and the Fed is not acknowledging what's really happening here. So behind the eight ball is that they don't have their tools that they used to have. Like in 2008, the tools that they had were, we can take inflation, we can take rates to zero tomorrow, and we can print whatever we want. And because we don't have inflation, those were powerful, potent tools. Well, they're gone. They're both gone right now. And everybody's ignoring that massive shift. So that's gone. And then in tandem with that, the Fed is juggling more balls in the air than they used to because of this meant. I mean, they used to only juggle two balls, and mainly it was inflation, but it was basically just this, moving in interest rates up and down. I mean, that's what they did. We move in. It wasn't. We weren't injecting money. We weren't bailing people out. That didn't happen. It was just little. If you go and look at their balance sheet prior to 2000, there's none of that. None of that. This is all new stuff,
Yep.
right? And nobody even talks about it. It was a paradigm shift for what the Fed was really doing to the economy. Well, guess what? Now it's all on them. Now they are the economy. They manage the economy. Well, what happens now if we go into recession? What happens? I think it's going to be, a massive, massive problem, and everybody's going to realize it, and fear is going to explode. And the reason why is because they just announced that they're going to borrow $1.3 trillion the last 2 quarters of this year. Half of the year, 1.3 trillion. 1.3 trillion for a full year would be a high deficit.
Right.
Well, guess what? They're borrowing 1.3 trillion when the GDP is at 2.5. I mean, that's just it's insanity economics, which is what this leads to. And you could say, that the Fed isn't behind this, the U.S. Treasury isn't behind this, this is the government, this is Washington. Don't believe that for a second. The Fed and the U.S. Treasury, they're like the big advisors of Congress on how much debt you can do. And if there's a problem, they're going to say something. So they're not saying anything. They're allowing these huge deficits to occur, which is ironic because those huge deficits are actually keeping inflation going and letting it's counterproductive, right? You're printing all this money and you expect the inflation to go away. It's basically this fiscal dominance, which is a big problem. So
Mhm.
if you're borrowing, my final thought on this, when you're borrowing 150 to 200, a minimum of 100 billion, but 100, 150, 200 billion every single month, at a certain point, you run out of buyers. And when you run out of buyers, then the Fed has to come in. And when the Fed comes in, that creates inflation, because when the Fed comes in, that's money printing. If
Yep.
you're selling to an investor, it's not money printing. But it could be money printing if it's Europeans. The Europeans might be printing euros to buy dollars. That's a possibility. But mainly, when the Fed has to come in, that's going to create more inflation, and that creates a doom loop. Because if the Fed has to keep coming in over and over and over again, once people realize, uh-oh, the Fed is bought 50% of that auction, that
Yeah.
means inflation. I don't want bonds. I'm going to sell my bonds. That's how it works, because people see, and it's every month, every 30 days, right? So every 30 days, the Fed is buying 50% of the auctions. People are going to go, I don't want these bonds, because if they keep printing like that amount of money, then the bonds are going to be worth less and less and less. And so foreigners are going to dump them. That's the doom loop. And I think it's inevitable, because once the Fed jumps in, once they monetize over 50% of these auctions, the writing will be on the wall, because between now and then, inflation will not go away. Inflation will be with us. So if inflation is already with us, and then they're basically saying, we're going to give you more inflation, it's a recipe for disaster, if you will. That's why I say my recommendation is you panic, because we get to Q4, and I think it's basically the margin call all over again, where Jeremy Irons says, I can't hear the music. right? The music has stopped.
Right.
In Q4, the music's going to stop, in my opinion.
Yeah. Okay. So I guess, to kind of paraphrase or rephrase what you just said in terms of panic, because I really don't like that word with investors. I would rather say, hey, look, don't be greedy, right? Look at your 401k from March of '09 to now. It's been a 15 and a half year rally, people. Like you have to take some money off the table sometime. If high flyers like Nvidia are taking a big haircut, that should be a sign to you. Look at the market since the Trump assassination attempt. Look at the last 12 business days. That's been 12 business days, right? The tech market has not been able to catch a bid, and it's problematic because that has led us higher, right? When you see that kind of stuff, or the Russell 2000 lead us down as it has in previous corrections, like that's a sign to you to say, I got to take some money off the table if I'm a momentum investor. That's just a really easy way to do it. But I guarantee you, most people aren't doing that right now. They're like that Hunter guy, right? They're like, oh, Fed's going to have our back again. I don't think so this time. I think it's going to be way different as we progress into 2025. So, let's pivot into gold and silver. Gold, obviously, kicking butt still in terms of its resiliency. Last year, you and I were talking about 1900 holding for, what is it, 5 months without a close below 1900 or something insane. And now we're seeing the same thing above this 2250 to 2300 level. I mean, every time we get near 2300, gold just spikes, and it's really, really positive. I mean, especially for producers. We're going to see Agnico come out with earnings tomorrow night, after the Fed. So we'll see how their quarter looks. But Newmont, when they came out a week ago with their earnings, they spiked down about 4.5. I think that day you and I were talking a little bit about that off camera, and then it's really rebounded a bit more since then. So we're seeing some resiliency in our sector, which is unusual in mining, which is a very big positive, I think. And I think these companies will continue to put up good quarters if gold holds in there above 2300. What do you think?
Yeah, this is glad we get to talk about this. So gold broke out in March. You mentioned the 2300. I became bullish in April. The first week of April, I became bullish. I basically said
Yep.
the correction is over. So we've been in this, we almost had a 4-year correction. And as far as I'm concerned, the correction ended in the first week of April. However, it hasn't manifested yet, but I think it will. But gold clearly broke out first week of April, and it's been leading everything since then. I basically say gold is the leader right now. It's the market leader. It's the buy the dip asset. So I see gold in a range from 2200 to 2500, and it's kind of stuck in that range. I think that the next move, I don't know what's going to hit next, 22 or 25. I don't know, but I do think that we'll go sub 23 before we get to 25. And we'll go sub 23 because of this market sell-off. Well, I think this is the top end. And we're basically going down and going to get a cycle low. So I don't know where that cycle low is going to be, but I think it'll be sub 23. And I think 22 will hold. If 22 doesn't hold, I don't think we'll stay below 22 very long, because maybe a few weeks, because I think gold wants to go higher this year. So I'm super, super bullish that gold is the next breakout is 2,500. So we're waiting. Basically, there's two numbers for me that are most important: is the S&P and then gold. And so I have certain numbers on each one. So gold for me is those two numbers, 22, 25, cycle low, and then breaking out. So once you get to 20, and then silver, in my opinion, is irrelevant here. And the reason why it's irrelevant is because what's going to drive silver is going to be the combination of gold and financial uncertainty. And so once gold gets above 2,500, I think financial uncertainty will go up. So whenever financial uncertainty goes up, the GSR squeezes. So if you go to 2,500 and you take a GSR of 70, you get to $35 silver. So $2,500 gold equals $35 silver. So silver's at $28 today. I say it's irrelevant because it's going to rip $7. It's going to go up $7, which is it's a 40% move. It's going to do it really, really fast. Zippity doo dah, we're at 35. And then I don't know when we get to $2,500 gold. I mean, it might be September, it might be October, it might be in November. I don't know. It all depends on kind of what the stock market does, how much it pushes gold down, how long it takes gold to get back to 25. But I think it's going to get. I think it does get back to 2,500. Um, definitely Q3, early Q4 is my expectation. So then, if you get to
Okay.
$2,700 gold, then I think the GSR squeezes more. So we're at 70. So we're at 70. I think we're going to be at 70 at 2,500. I think we're going to squeeze down somewhere between 60 and 65 when it gets to 2,700. That takes silver to 40 to 45. So I think we're going to end the year $2,700 gold, something with silver somewhere between 40 and 45. So I'm big time bullish. But in the near term, like I said, I think we're going below 2,300 on gold. It's possible that gold leads here and just keeps ripping higher, but I don't see that. I think that as the market, the key, okay, and then I mentioned the two numbers on the S&P. So the numbers on the S&P for me are 5,200. And as long as we're above 5,200, I think Wall Street is basically has a smile on their face and they're confident and they're bullish. Below 4,200 and they start getting nervous. Below 5,200 and you're going to start seeing some negative reports. Then the next number is 5,000. And then if 5,000, they'll state, basically you get more bears the lower you go, right? Below 5,000, the bears start to more appear. And then the big number is 4,800. If 4,800 doesn't hold, the rats are jumping off the ship. So for me, when gold starts going back up, is going to be somewhere between 5,000 on the S&P and 4,800. Somewhere in there, gold will basically start going higher. That'll be the decoupling. And when that decoupling occurs, that is when finally, that's what we've been waiting for. Remember I said that in
Yep.
April, we broke out in gold and everything else hasn't broke out? So when gold finally decouples, that's when you get the Hui above 325 and you get silver above 35. So those are your breakouts. We want all three of them to break out. So you need gold 25, silver 35, Hui 325. You get all three of those, you get above all three of those numbers, and guess what? You have a bull market in all three, and you have at least a 2-year run ahead of you. That's my expectation. And so this is the very, very beginning. I mean, if you look at the Hui, I mean, like I said, it's at 297 today. The all-time high is 625, 635. We're not even 50%. We got a long way to go just
Yeah.
to get an
And
all-time high.
that's a great point. I mean, that is probably the most frustrating thing for investors, and the spread, if you will, between how gold stocks are performing versus the price of gold. The HUI clearly, talks about that, right? Where you're not even seeing half of the all-time high, yet gold is near an all-time high. So I think there's tremendous upside in a lot of the mining companies. Um, I would slightly disagree with you in that the $1,900 gold thing last year was really big for me. You and I talked about that multiple times on our show, and that created a new floor on gold. That's what I think is happening right now at the 2,300 level, where a new floor is being created to break out from. So I think the tables are turned in our favor if you're a gold investor right now. Sure, we have some seasonal weakness right now in July and August. Sure, you've got, to worry about Jackson Hole, as I talked about earlier in August. But once we get to the fall, I think there's a higher probability of, the S&P turning over, as you've talked about, Don. Like you've got seasonal weakness in the S&P starting in September and October. Those are the two worst market months going back to the Great Depression. So I don't see this one being any different. I see it being potentially worse for the S&P or the Nasdaq because of the euphoric kind of behavior that we've seen in these two indexes over the last few years. So we'll see how it unfolds. Right now, if you're good with it, I'd like to introduce Shaun and bring him on to be able to talk a little bit about 1911 gold. So there he
Yeah,
is.
yeah, let's do it.
Hey, Shaun, nice to see you.
Nice to see you guys too. I listened to the whole thing. It's going to be a tough act to follow there, Don. But
Well, why don't you provide a 10 to 12 minute overview, Shaun, of what's happening at 1911 Gold, and then we'll ask you some questions.
Sounds good. Sounds good. I'll assume that most of your viewership um, hasn't spent a lot of time looking at 1911, so I'll try to kind of start from the ground up a little bit without getting bogged down in the detail too much. But essentially, 1911 Gold, as Don mentioned, was spun out of Klondex back in 2018. It holds the entire Rice Lake property, which is about 3 hours north of Winnipeg in Manitoba, but more importantly, lies about 100 kilometers to the west of the Red Lake camp. I'd say the major defining feature here is the fact that we lie along the same structural, fault structure that feeds into the Red Lake camp. It's an ancient plate margin that runs kind of stretches right across to the Spring Pole mining project with First Mining. So all the same types of rock, structural controls, geological features which you find in Red Lake exists also within the Rice Lake camp. We have 100% of the property. It's over 63,000 hectares in total. It's a consolidated land package. A lot of that consolidation really only happened initially under Klondex, but primarily really under 1911. We staked and purchased claims straight across that Wanapagao fault, that primary fault feature, to make sure that we had a very good land position to feed into long-term future growth and continue to build up a number of exploration targets for a very long term. The one thing we didn't do, and this is something Don and I have spoken about many times in the past, is we really had not focused on the assets we already had, which includes an operating permitted 1,300 ton per day mill with a permitted tailings pond, recently constructed. It's I think they completed the build on the new part of the tailings in 2013, so it's in great shape, lots of room. Full camp infrastructure, but the most important thing really was the existing underground mine, which is a 1 million ounce resource, 6.4 grams per ton, about 430,000 of those ounces are measured and indicated. Conversion to proven and probable really just means getting back in there and turning it into an economic mine again. That whole project basically got put on the shelf for the last few years, but over the last, say, 9 to 12 months, you've seen a real transformation in the company in that we've kind of refocused on that resource. We brought in guys like Gary O'Connor, who's responsible really for turning around that Tower property at Manita, had a significant experience at Dundee and actually had been to site with Dundee during his time there several times. So he was very familiar with the Rice Lake project, saw the potential. We brought him in as an advisor. We've now brought him in as a executive chair so that him and I can work kind of hand in hand on this resource. And then we've started to make a number of changes at site to make sure that we've got the right group of people leading this project forward. So Michele Della Libera came in as VPX, really, again, transforming that exploration role that we had before. We're now very much more focused on resource development, resource expansion, and identifying still long-term opportunities across the belt, but reprioritizing and refocusing on that underground mine and the growth potential within that mine. So what you're going to see now is, look, we're going to leverage off of the existing infrastructure we've already got. We're going to grow the resource. First step, actually, sorry, just to back up. First step's really been to audit that 1 million ounce resource. We did that. We completed that work by the end of April. So we've had a third-party consultant come in and redo that resource, came out with the same numbers. So we felt very comfortable with those numbers, and which is why you've seen a bit of a pickup in the marketing with Gary and I since that time. Like, we're very confident now that that's where we're going to end up. We brought in Michele in middle of March, and he brought in a team underneath him to start rebuilding it from the ground up. So we've now completed that work, and we've just handed that off to the estimator just a few weeks ago. So we're probably going to come out with a new updated resource towards the end of August. Likely be similar to what we had before. There could be some changes, but underlying that now is a much more robust, more user-friendly model. The old one had a number of issues with respect to the way it was put together because it was established over time with a number of different people involved. We've now cleaned all that up. It's helped us develop new targets, identify some new prospects in and around the mine area. And that'll be the second phase of what we do. So following that August re-release of the resource with updated numbers, we'll also have updated targeting, updated plans with respect to where we go first with exploration in and around the mine. and where we see the path really to growing that resource lies for us. So we're targeting kind of a 2 million ounce resource on this project. We're going to get there on just this mine area alone. And then longer term, we've got a few prospects across that belt that we've already identified as having potential resources for the future that are within economic trucking distance. We're talking 20 minutes away off a main road, which if you look at our map, you can kind of see a road extends right across our property. So good road access throughout, and we'll be looking to develop opportunities in the near term right off of that road. So those will be our second phase of priorities, kind of probably early mid next year, I think, on that front. So longer term, building a large pipeline of potential ore for the mill, starting in and around the existing mine, adding to our team. So we'll be looking at bringing a mining resource here in the near term as well, and starting to build out our plans for future production. It may involve doing a PEA at some point late this year or into next year. We might hold off if we want to do more drilling, but those are the kinds of critical steps for us as we progress down this path back into production. And really the goal here is like, look, we haven't historically gotten any value for these assets in the property. You look at some of our peer companies and they're trading at 10 to 15 times above our valuation without the assets we've already got on the ground: permitted tailings, permitted mill, an underground that's got all the infrastructure already in place. Obviously, we need to do some development, but really, we don't need to mine to the resource. The resource is still kind of in close proximity to the existing infrastructure. We have a really good starting point, and we just need to continue to refine and develop those plans. And the fall is looking pretty busy, so hopefully we can fight these headwinds in the market and start to separate ourselves from the peer group, and people start to view this as an opportunity to gain some leverage to gold price, which is typically what these junior mining companies have been in the past, right? If you believe in gold, and I think everybody on this call does, and believe that it has significant potential in this economic downturn that we're headed into, and this monetary uncertainty, I think really you want to have gold. And if you want to increase your exposure to gold, you need to start picking those mining companies that are able to really show a path to profitability. And I think we stand a really good chance of being one of those, given where we are and what we've already got in place here.
Don, if you don't mind, I'll start off. So, Shaun, I always like to ask, not only for the good and the overview, but also what could go wrong, right? Because we know what happened with Victoria recently. We saw what happened last fall with Marathon in November, selling for pennies on the dollar. This is something that we, Don and I get in terms of inbound emails from clients as to why did these kind of things happen. So, what do you think, in your view, could go wrong? I mean, obviously mining is a very difficult business. You just mentioned that you might want to do a PEA. That could be something that could help, I think, in that it probably would be done at a much higher gold price than any other previous reports, right? So it would kind of shed some light on just how much promise the project has. But I don't want to put words in your mouth. Why don't you just let me know what you think?
Yeah, well, obviously those are front and center in the market right now, and none of that really puts the rest of us in a good light, even though those often tend to be situations that are specific to those mines and those companies. I think, to be honest, I feel like a lot of that's just a result of the capital-starved nature of our industry, and mining companies doing what they have to get themselves to a stage where they can turn a profit, and hoping that things are okay. Where I think we might stand apart a little bit is like, look, well, this is an underground deposit. Relatively low surface footprint. There's really not a lot of disturbance, which is why they tend to be easier to permit. So permitting risk tends to be pretty minimal here. Manitoba is a resource-friendly and supportive jurisdiction, both in the oil and gas, farming, and mining community. They see those as the pillar and the backbone of the province. And in terms of tailings, as I didn't actually mean to emphasize it, but I ended up doing it. But I mean, it's a relatively new build in terms of tailings. And we're in a situation where the the nature of the ore that comes out of the underground's clean and has very little in terms of has no arsenic, no cyanides going out there or anything like that. So there's really nothing particularly dangerous going out to tailings other than the tailings itself. So we're able to discharge, 1 to 2 times a year to the environment if we need to. Obviously, we're doing, the sampling and all of that activity. But still, obviously, things can go wrong. And a lot of it's going to be more on the engineering side. We have the big task here is figuring out the way to profitably mine this deposit. True North is known as being narrow, high grade, and the historical issues here have always revolved around. There are some operator issues, but the real issues have always revolved around dilution of the ore body and taking it out of the underground. Using an inappropriate style of mining here is what leads you down that path. I would say historically that's arisen because the equipment to do long hole open stope mining was what was available, and that's what was used even under Klondike. They really didn't change anything when they got underground. They used the exact same equipment that Sandgold was using in the past. We've basically wiped the slate clean, more or less, because a lot of that equipment's no longer there. We'd be looking at automating and mechanizing as much of the underground as possible so that we kind of create a nice, safe working environment. Obviously, if you electrify a lot of it, you've got less ventilation issues, those kinds of things. But really, this is the main what can go wrong here is like we get the ore body wrong. We've got a lot of, one thing Scott Anderson, our former VP, did exceptionally well was understand the nature of the ore bodies on this property and the controlling structures. So we're very confident about the model we're going to be using for our exploration going forward, which is a big difference between us and some of the predecessor companies as well. They were following the wrong kind of structural features in terms of where they oriented their drill. They were hitting the right target at the top, but they were following it down at the wrong angle. The True North mine, the original shaft mine, is done 100% correct, but that's because the old guys that used to do this back in the 1940s, 50s, and 60s, they knew what they were doing. Everything that was done from like 2005 on started off right, but ended up going very wrong because they were kind of following it in the wrong way. So we think we've got to figure it out. Of course, everybody usually does. And that would be the second risk here is that, look, we got our models wrong. It takes us a lot longer to develop these resources because we're just drilling it wrong. And then the third thing is the same issue that every other mining company has in this industry. If the market's not willing to come along for the ride and support the investment needed to develop these assets, it's going to take a lot longer to develop them and get them to where they need to be. That just means a company like us is going to have to bootstrap its way into production, focus on extremely small scale production initially, and try to cash flow its way up to a level where it's back to 100,000 or 150,000 ounces of production, which is really where you want to end up in this industry to kind of, re-rate the company to, $1 billion type company again. That's typically where you start to get those large valuations. So, okay. I don't know if I answered all your questions, Shaun, but those are kind of the key things here: engineering, geology, and access to capital. Nothing particularly earth-shattering, but the property and the asset itself are not a risk here.
Okay. No, I think you did a great job answering that, Shaun. The other question I had was you had mentioned the peer group. So what do you consider the peer group?
Well, the easiest one is West Red Lake. They're just 100 kilometers to the east of us, doing the exact same thing. They're just ahead of us, right? They're better capitalized. They got a group behind them that's been able to put it on their back and carry it forward. They're trying to turn around a mine. They got a mill, permitted mill. It's a little smaller than ours, probably hard to imagine, but it is. Ours is quite scalable, right? So typically it's 1,300 as it's currently configured. You add some additional crushing capacity, that turns into a 2,500 ton per day mill. So there's a lot of potential for growth here. But so a lot of similarities. I'd say our infrastructure on surface is slightly better, but their ore body's a lot more developed, and they've had a lot more drilling done in the last 5-6 years than we have. Obviously, we're way behind, so we need to catch up. The valuation obviously reflects that. They got a bigger team, but there are a lot of similarities. There are a lot of similarities with stuff that's not in production too, like the Dixie properties, a pretty straightforward analog to our central Manitoba, southeastern part of our property. very similar. Again, that's just literally about 120 kilometers away, on very similar type features. But there's a history of mines that have been turned around successfully and some that have not, right? So Hard Gold was, didn't work out, but got pretty close. Island Gold, obviously, a huge success. So,
Yep.
we take a little bit of page out of everybody's book and try to figure out what went wrong, what didn't go, what went well, and put together the right team to make sure we can kind of focus on the latter versus the former. So.
And what's your market cap right now versus, say, something like West Red Lake?
What are we? 16 million today, I think. 16 million versus West Red Lake's got to be around 150, 160 million. I think it's traded off a little bit. If you put the two, we've had a really good year. I think the turnaround starting kind of in September last year, people have seen the direction we're headed, and then as we've been adding experienced resources to the company, people have been starting to get back into it. They see that the balance sheet's been fixed. We had a rough year in 22. We got in over our heads on the tailings reprocessing and started losing money towards the last half of that year, and just, had to fix the balance sheet in 23, but that's been done. We've added people, and the direction we're taking and the strategy is much clearer. So it's starting to get reflected in the stock price, but we're still, we've got a long ways to go before, we reflect the value of what we've got without doing any work. I mean, this is a 50-60 million dollar asset in an average market. This is just, me, but it's a 50-60 million dollars market cap in an average market without doing anything. But once we start to show the growth potential, this is easily, back to the high flyer neighborhood where it was at one point in time. This is like $1 billion back in 2012 when we were all throwing money at everything. But
Amazing.
Yeah.
Amazing. Okay. Well, thank you. Don?
Yeah, what Shaun was referring to, $1 billion back in 2011, that was Sand Gold.
Yeah.
And so, yeah, so I was give you a little overview, I'd like to educate people that the boxes of this project checks, if you will. So the first thing is the project. So the project is very solid, 1 million ounces at 6 grams per ton. The capex is going to be very low. The time to build it. So the economics, I mean, at 6 grams, I mean, we should get an AISC $1,500, $1,600. I've always said this is kind of a really solid project optionality play for the long term. Like the previous management team, they had no interest in focusing on True North. And I was like, just get ready for higher gold prices, but they didn't have the patience to do that. It would have been, they'd have to be very patient to do it. So they were just basically diluting shareholders and drilling. And I didn't like that approach at all. And then Shaun came in, and he basically now he sees the vision when the price of gold has went up. But I've always thought that this project, it works at $2,400 gold, and it just gets better. So as an optionality play, at $2,400 gold, if he's in production today, his free cash flow would be at least 30 million, I would think, somewhere around 30 to 40 million. Yeah. So at 10x, it's worth about 300 billion. And then it could go up from there. So I mean, the starting, as far as I'm concerned, the starting valuation is about 300 million for what he currently has, but he's probably going to go up. So the project is really solid. Then the next thing is the location. The location is fantastic in Canada, Manitoba, great location. And then valuation. This thing has 10 bagger written all over it. So valuation, it's super, super cheap. Shaun mentioned, he's valued at 17 million. I have you valued at 20 million fully diluted, 207 million fully diluted shares. So you have a lot of warrants out there that can get converted into cash for you, possibly. Mm-hmm. So you're very, very cheap versus what, as far as valuation. Then the next one is management. I think the one thing about development projects is you want a team that's done it before, and a board that's strong. You don't want a team that is going to basically sell early, sell before they get to first pour, or sell immediately at first pour. And so I think this, and you want a management team that has vision and kind of sees the upside. You mentioned, Shaun mentioned, that he wants to get to 100,000 or maybe 150,000 production. Well, that's a down the road type of vision, and I like
Sure.
that. That's the way they should be thinking. The next one is a path to production. And Shaun says, we got work ahead of us. And I mean, I see the path to production. It's fully permitted. The one thing the one red flag, I'm going to come back to the path, but the last one is insiders. The last bucket is checkbox is insiders. They have 40% insiders, which is plenty to block. So if they get a phone call and somebody calls them and says, look, we want to buy your company, they're basically says, sorry, we're not for sale. So even if you offer us 100% premium, they're like, sorry, and we don't want 100% premium. So they're not interested in that. I mean, they might do a deal of equals, like two companies of equals, so that their balance sheets improve. I mean, they might be open to something like that, but that would help shareholders. But anything that doesn't help them, they're not going to do it. Eric Sprott owns 12%. So they have some really strong ones. So let's go back to the path to production. So this is my first question to you. So, this is kind of my concern. The previous management team basically said that there's no reason to focus on True North because we can't fill the 1,300 tons per day. Well, the previous mine, Sandgold, they didn't stop because they didn't have the ore. They were producing 70,000. So 1,300 tons per day at 5 grams is 76,000 ounces, and they were producing 70,000. So they were having no trouble filling your mill up. But we need, basically we need that PEA that shows us, look, we're going to mine, we have the ore to do it. And you said that, you're not sure when you're going to do a PEA, but now I would think that you guys should be super excited. Gold's at 2,400. I mentioned, I think your free cash flow would be at least 30 million. The gold goes higher this year. As gold goes higher, and you're definitely aware of this, as gold goes higher, your company just gets more and more interesting, right? And so why did you say that? Why did you say we're thinking of doing a PEA? I mean, you got to do scoping of some sort. You said you did this auditing, you kind of understand it. So my question is, how much more drilling do you have to do before you can do scoping? What is the timeline that you're seeing that you can basically get to first pour?
Yeah, the thinking was more in the context of the timing as opposed to the possibility. The PEA will come. It's a matter of what is the best possible time for it. And obviously you want to, be careful in terms of putting that out there and saying it's going to be out there by this date, because you want to always reserve the right to hold off if you think there's some better information coming that may make it look more attractive or potentially show a bit more potential. I do expect, and Gary and Michele are of the same view, that's got to be our next priority. That and and additional drilling in and around these mine areas. The purpose of the near-term drilling really is to show that there are extensions in a number of areas. So there's potentially open resource available for us to upgrade it, or areas that are upgradable into a resource below the 007 mine. And these are some of those ramp mines off to the east of the main shaft mine, still in the same mine footprint, main mine complex. And then there's areas in between the Hinge and Cohiba mine. And so we'd like to try and test those and build those out, because those will really, to your point about feeding the mill and having the ability to make sure we make the minimum capacity, those will really help us get there and show the path to providing enough feed for the mill. Historically, yes, the excuse for not looking at True North was the shaft mine is really a 500-600 ton per day operation, and the mill's 1,300 tons a day. In talking to the previous operators, mainly Klondex, they've indicated, look, the mill can be run at 900 to 1,000 tons a day. It doesn't have to be 1,300 tons a day. So really, my focus is on let's get to where we need to run the mill profitably. It is obviously, as with any other mill, it's a largely fixed cost operation, but at $2,400 gold, even if you're putting 900 tons a day of 6 grams or 6.5 grams per ton, you're going to do quite well, right? I can't work out the math here, but that suggests to me, yeah, probably around 20 to 25 million there, right? And then as you start to push it up, your cash flow gets significantly higher. It's about running it properly and making sure that you're not breaking it down, which is what happens if you put too little in terms of tonnage through it. But on top of that, that statement was really focused on just the shaft mine. So the second part, going back to the drilling, proving up the thesis that there's additional resources in the Cohiba mine, the Hinge mine, the 007 mine. 007 is a mine that you get to through the Hinge mine, so that's how you get to that one. But additional resources in there provides another 200-300 tons a day of feed, all at basically the same grade and more or less the same metallurgy. There's really no difference in terms of the type of rock coming out of those grounds. There's slight differences in the integrity of the rock in there. Like 007 mine historically was quite fractious. Gary says boutonage, I guess. So basically you'd mine it and it would kind of crumble and fall in. So there was a lot more dilution in that mine. We'll have to be very careful about going into that one, but there's a lot of resource there. So I think, it behooves us to figure out a way to mine that one properly and feed the mill. So that's where the growth is going to come. The near-term growth is going to come from those ramp mines. So starting with the shaft mine, because that's where the bulk of the resource is, stepping into those ramp mines to grow it and start growing it and increasing the overall tonnage. And obviously increasing the ounces, and then longer term in that kind of 4 to 5 to 7 year time frame, bringing on the Ogama Rockland resource out in the east, the central Manitoba area that we drilled late in 22. That's got a lot of potential for a large ore body. Could be another. I mean, honestly, it's a 2.5 kilometer structure on surface. Compare that to True North, which was 2 kilometers on surface. It's big open ground. There's potentially another very large deposit there. And we haven't even really touched it. So we need to earn our right to get back into those regional targets, which means, proving out our thesis on these existing underground mines first. But that's essentially it. How Sandgold fed the mill in the past is not really the route we want to go. Pushing tons, developing sections in the underground that had very little in terms of resource, but by pushing tons you can kind of reach those ounces produced targets, but your cash cost per ounce is over $2,000. Like, we don't want to be a marginal producer here, we want to be a profitable producer. And the AISC may end up being around, look, we haven't done the math here, so we're just picking numbers, but it may end up being $1,500-$1,600 an ounce. That's going to be Canadian dollars. And Canadian gold price is $3,300 an ounce. So, that's a significant cash flow difference.
Yeah, you don't need to hit that number. Those numbers are outstanding. I mean, you have a lot of room for error. If you will.
We do. And there's a lot of upside here, right? So
yeah,
we're just proving the primary thesis here first, and then we're going to show the growth.
Yeah, you could miss by $300 and it still works.
Yep.
Now, at 1,000 tons per day at 6 grams, if you run the mill 355 days, so it's down 10 days, you produce 68,000 ounces, which is fine, right? So that's kind of what you're after. And if you do a little bit better than grade, if your head grade is a little better than 6, then you get to 70,000 ounces. Turning the mine back on at 1,000 tons, I think that's a really good target, a really good goal. I wanted to mention about your property is large. This is not a small property. How many hectares is it?
63,000 hectares, all continuous.
It's a big property. One of the reasons Sandgold had $1 billion valuation was the exploration potential. There's it's 1 million ounce, but as Shaun said, his target, he thinks they're easily going to double this thing. And that's the reason why, one of the reasons Sandgold was at $1 billion is because this is a good property. It's a very good property. They're getting zero value. The market cap is $20 million. They're getting zero value for the mill. They're getting zero value for the optionality. They're basically only getting value for the 1 million ounces in the ground, $20 an ounce.
Discount.
That's all you're getting.
Yeah.
When you're an investor, you're just paying for the gold in the ground. So for me, I like development stories that check all the boxes, and then they have optionality. Optionality isn't one of my check boxes. It's like that's kind of the extra one. So it's like, extra. So yeah, I've been a shareholder in this for a long time. I'm a fan. I mean, you can just see because I believe gold prices are going higher. So this project, put it this way, True North gets turned back on if gold goes north at $2,700. It's that simple. It
Yeah.
gets turned back on. It's very, like I said, it's a really good comparison to West Red Lake Gold. But here's the thing. I mean, it actually has less risk. Red Lake Gold, that gold went bankrupt because of when costs were high, where they basically they didn't hit the grade number, and people are a little nervous, a little concerned. Is the head grade going to be there? Whereas True North, we pretty much know the head grade is going to be 6 grams. It's not going to be 4 or 5. They should have 6. They mined this before. They kind of know the ore body. They know the ore. So in some respects, it has less risk than West Red Lake Gold, which is a big irony.
Yeah.
Oh,
Yeah.
I'll turn this back to you, Mark. I think that's all the questions I have.
Okay. Just to jump in there, I mean, historically the grade in the last few years of Sandgold did drop off, but that was the dilution factor, which I touched on, right? They were trying to get ounces up, which meant they were doing long hole open stope mining on areas that they had no business taking out, 8-meter sections when you've got a 1.5-meter vein width. You're going to go from 6-7 grams to 3 grams pretty quickly, but you back up and yeah, 6-7 grams per ton pretty consistently for a very long time. So yeah.
Yeah. But that was more of a management mistake than an ore body mistake, right?
It was, and I think there's a number of reasons behind it, and it's just a sign of the market that they were in at the time, right? It was pretty frothy, and gold price was very choppy at the time, and people were doing stuff that
Oh,
they
I
shouldn't have.
did. I did have a final question. You did a contract. You didn't mention this. You had a contract for toll milling for a percent of your
Mhm.
mill. Now is that in effect now? Are you currently toll milling?
No, we do. So we have an agreement with Grid Metals for processing lithium spodumene from their Donner property. It's about 90 minutes to the south of us. That agreement, the clock is ticking on the lease agreement, but we've not taken any of their ore, and they're not actively mining yet. I think with the lithium price as it is, they're a bit on a wait and see. But the period, like the actual agreement is ticking, right? So we're not losing time on our side, because the idea was always that their lithium will probably fall off by the time that we need, say, 2,000 tons a day of production. In my 150,000 ounce scenario, that's how many tons we need to be producing, which is kind of why I emphasize that this is a scalable mill as well. So between Grid and we've just kind of worked out
Yeah,
the
it's
math.
not gonna,
There's capacity.
right. It's not going to stop you from mining 1,000 ounces per day.
No, it won't. Yeah, no, we'll still be able to do enough to
Oh,
production for what
yeah.
we want to do.
I keep thinking I'm done and I keep getting questions. So you have about 2 million in cash now. How much cash are you going to need for 2025? Do you think?
That's going to depend on what kind of drill program we come out. So every phase that we complete is going to dictate what we do at the next phase. Drill program in the mine site area is relatively inexpensive. It's $180 a meter, let's say, if I'm being generous. It's probably a bit less, just because we don't have to clear roads and it's all there. We've got, as you mentioned earlier, about $6+ million of warrants that are floating around out there that are now in the money that'll probably start to trickle in. If we need to get aggressive and get underground and start drilling into the resource, because to be honest, some of our best targets are at depth. There's that 16 level and that 26 level that's about a kilometer down. A lot of the really high grade material is down there. If we get enough market support and interest, that's going to change the number. But you could be looking at about $2 million to spend by the end of the year for this year. And it could be a delta between 3 to 6 million of spending for next year. Again, it's going to really depend. we do have some sources of cash over the interim as well coming in. So, I mean, there's obviously some payments still from grid and a few other things that levers we can pull on to get some cash in the company. But we want to move quickly while the gold price is going in the right direction and make sure that we deliver on all our promises. So,
Do you have any NSRs?
no, this is a royalty-free, debt-free property.
Well,
Nice and clean.
man, it seems like the NS because you don't want to dilute your like now's the time to kind of raise money because your valuation is 20 million, so a 10% dilution is only $2 million. So you could, and then you got to do the cap. Well, you're probably going to need some money to restart the mine. So, but you could borrow money. You could borrow that. But this drilling, it seems like an NSR kind of really makes sense here to raise some money for drilling.
That's certainly something we've looked at. I think NSR will get the most out of it when, we could do a little bit initially with the resource update and then a larger, maybe like get more once the PEA is out there.
Right.
The other thing to remember also here is that Manitoba has a really good flow through deduction. So you're able to raise money even with the change in I'm sure you guys have heard the changes up here. It's getting more horrific by the minute.
There are a lot of aggressive royalty companies out there right now. So Vox Royalty, they focus on NSRs. Triple Flag is trying to grow. And the other one that's trying to grow is Gold Royalty Company. Those three, you should contact all three of those guys. They all three should bid for your NSR. They're all looking. Your project is right up their alley, right? It's like 10-year mine life, slam dunk Canada. Once you start producing, the money's just going to flow to them, right? So you are right in their sweet spot. So I would, if you contact those three companies, I think they're all going to give you an offer, right?
Yeah, you're
those
right.
Those are just three, but there are other names out there as well that might be aggressive too. But you get those companies bidding against each other, you're going to definitely get the upper end, right? You're in the sweet spot.
Yeah.
You're exactly the reason why you're so beautiful to them is a lot of their NSRs do not pay off for like 5 years. Whereas your NSR, it's like they buy it in 2 years or 3, it's not going to take long. Boom, they're going to get making money.
Yeah, well, and there's very little execution risk here, right? They're never 100% certain that some of those projects are going to happen, right? So
yeah, you are in the sweet spot. I got to believe you contact those three companies, you're going to get some nice bids. You do a 2% NSR, and you should be able to raise some nice money.
Yeah, that's certainly royalties is much more attractive to a company like us than structured debt or something like that, where you could quick path to CCAA.
It's the timing. It's the timing, right? The timing. It's
They're good partners.
The time to do it because you need cash to drill right now. You don't want to dilute your shareholders. So it's so I hope that unfolds. Okay, I'm done.
Okay, all right. Shaun, thanks a lot for coming on. We really appreciate it. And
no problem, John.
Don and I will recap things here, and we'll try to have you on after the PEA is announced down the road.
Sounds good. Yeah. Great to talk to you both. Good to see you guys.
Shaun, thanks for having us on. One thing I want to say is there's a very good chance you get back to $1 billion valuation. I mean, you're 20 million US today. I think there's a very good chance you get back to $1 billion. I really do. So it's not going to be a shocker if you get there. All you need to do is double your resources. That's it. You double your resources and you're there.
That's what we're focused on. I mean, and this is a great property to do it on, right? Like you said, it's got ticks every box. So,
all right, Shaun. Thanks for being on.
Guys.
Good luck.
Thank you, Shaun.
Thanks.
Done. Nice job there.
Thanks. I've been a fan of that project for a while. Before Shaun got there, I was a fan of the project. The previous CEO, I wasn't happy with his strategy. I thought he was wasting shareholder money by ignoring True North and drilling all these other areas. But now it's ready to rock and roll now. And I always thought $2,500 gold was the number. you get to $2,500 gold and True North works. It's that simple. So here we are. Yeah, this is really exciting. 40% insiders, I don't think they're going to sell. I think they're going to take this thing back into production. It's going to rip to, like I said, 300 million once it's in production. There's only one red flag here, and that's how long it's going to take them to get to first pour. But I think as the price of gold goes up, I think they'll be more aggressive.
Mm-hmm.
They'll go, price of gold, they'll like right now, they're not in aggressive mode. They're taking their time because they don't want to dilute their shareholders into the ground. He talked about he wants to drill, but it costs money to drill. The PEA won't be that expensive, I think $5 million probably.
I don't think it would cost that much.
Yeah, less than
Yeah,
five.
yeah, way
So
less. I think it's just a matter of, I think that is a good thing to do because obviously the last one was done under different management and it was done at much lower gold prices.
right.
So I think that would help to draw interest on things like you were
They-
talking about, the 2%
yeah,
NSR or whatever else.
yeah, and to borrow the money, they have to
Of
do
course.
that too, to get the
Yeah,
bankers in, show the IRR.
right.
Yeah, the payback on this is going to be less than 2 years. Yeah, it's going to be, yeah, Shaun's really done a great job. This stock is really um, under the radar, I think. I think it's
I
totally
agree.
under the radar. This is a stock that should double or triple very quickly I don't know, above $2,500, they do a PEA. Once the PEA comes out, I think this thing, and you're above 2,500, I think this thing could easily double or triple. And,
Yeah, well, I
and
mean, at the
yeah,
current valuation, I think he had said 16 to 17 million market cap. That's nothing compared to even their neighbor at West Red Lake. That's 1/10 of the market cap, right?
to replay, they're getting zero value for that mill. And if you just move the mill, it's worth $200 million. It's
Wow.
1,300 tons per day.
Yeah,
It's big. That's a big mill. That's a big
sure,
mine. Um,
sure.
so yeah, I mean, it's the replacement cost. I mean, if they sold the thing, it'd probably be worth 200 million. But the replacement cost is probably 300 million. I'm just guessing, but it's very expensive to build the mills nowadays, especially
Yes.
in Canada. So,
Yeah, and I
but
was encouraged to see a few months ago that they made Gary O'Connor the chair because I had met with him 2 years ago at a conference and we spent about 30 minutes. Sharp guy and a former gold CEO. So, nice to see them bolstering the board a bit there.
yeah, yeah, I like that. Eric Sprott coming on board. Um, so yeah, this is definitely a very exciting story. It's the valuation. It's all about the valuation, right?
Right.
Value valuation. It's just really, really cheap, and the upside potential, checking all the boxes. So I'm glad we could do this interview. I think people are gonna make a lot of money on True Gold. I mean, any mining stock is a speculation play. I mean, things can go south. They're never slam dunks. I always say keep your allocations low, right? I keep mine very low. I do not bet on companies, if you will. I just try to take small allocations and see which ones are the winners. But the more companies that I own like this one, my odds increase. So all I'm doing is, trying to put luck on my side. Um, it's like some people say luck is designed, right? You create your own luck by design. And so it's like you just want to own a bunch of companies like this and then cross your fingers and then wait to see which ones are successful. That's my
Yeah.
strategy. I don't bet. I never expect a stock to work. Never. I don't care how much slam dunk. Like Free Gold Ventures and 1911. I mean, these things look like they're going to work. And so people will go and put like 5-10% of their cost bases in it. I do a 0.5%. I
Hmm.
don't
Well,
do
you
1%.
also have in fairness like about 150 holdings, right?
Exactly, because that's my strategy. I don't, but I mean, companies they'll say they think that they're home runs or fat pitches, and they go and put 5, 10%, 20% of their money in it because they think it's a total slam dunk. You do that. Some of them will work, but they won't all work, and you're just that to me is just you're just speculating on top of speculating. You're already speculating, right? Because there's mining stocks, because there's so many things that can go south. I mean, just look at Victoria Gold. Who thought that Victoria Gold? I mean, that looked like a great mine, a really good mine, and now they're going bankrupt. Just one day, boom, their stock goes from $6 to what, 50 cents. Um, you just don't know. You
Yeah,
cannot predict things.
you have to
So
minimize losses no matter what, and that's something we do
don't,
really well.
yeah,
Is
don't,
we had a zero
don't,
weight on Victoria, we had a zero weight on Alexco, we had a zero weight on
uh,
Marathon, except I bought a little bit of Marathon at 40 cents, and it got taken out at a higher price than that. But honestly, we never owned it. Those are three newsletter favorites, right? And people that you and I compete with, or consider our peers, or we're pumping those stocks
yeah,
heavily, and none of them worked for various reasons. but
yeah.
but that's part of the game, is that you have to have a portfolio. Look, I have 55 names, you have 150, so both of us, by many client standards, we have too many names. But I would argue that you want to have a lot of names in this sector because of what you just said. You don't know what's going to work. Sometimes things will surprise you, and if you have a position on, it could save your entire year, because of just a couple of different names at work.
Hey,
um,
yeah. My
I
biggest
think we're
position
getting to a better
now,
place is the good news, right?
yeah,
Because we continue to talk in this context of even what I just said, right? It sounds somewhat negative, but you're conditioned for negativity when you've lived it as long as you and I have, right? We both got invested in this sector a long, long time ago. I started in 2000.
right.
I know you've been at it longer than I have, but I mean, it's you've seen peaks and valleys, and you have to know when to put the gas on. And right now is when you want to start buying this stuff, because gold is resilient, right? Like, it is not trading like it has in the past, where it will dip heavily. Like, we're not seeing those major dips anymore.
This
Dips are getting
is,
bought.
yeah, I think this is the last opportunity. Um, we've had basically a 10-year correction since 2012, 2013, even more than 10 years, 10 plus year correction in gold and silver miners. And I think it's all coming to an end. Once the HUI is above 400, and I think we'll get there by the end of the year. Stocks like 1911 are gone. There's no more of these things. They're done. You missed out. Now,
Yeah,
you go to the who's at 400, and you know, all these stocks have 2x, 3x. The quality ones, the ones that are cheap. So this is kind of the last. This is the last chance period. I think right now there's tons of stocks that are still cheap right now. I think
yeah,
between 300 HUI and 350 is going to be kind of the last chance. That's the last chance zone. Maybe you could say 350 to 400 is the last chance, but there's going to be slim pickings. 350 to 400 slim pickings.
yeah,
300 to 350 is last chance. You got lots of opportunities, but
yeah,
but slim pickings is we're not that far away from slim pickings. Maybe 60, 90 days. And basically everything's going to, start ripping. So,
yeah. No, I
Sean,
think this is always a seasonal period of weakness in juniors, minus a handful of years. July and August,
yep.
excuse me, is the time you want to be buying this stuff and put it away, because you'll just be able to get some good fills. Just in closing, Don, our conference that I'm co-hosting is in October. It's October 20th through the 22nd at the Fort Lauderdale Four Seasons, and it's going to host 35 different mining companies. We're doing a broad commodities conference, so it's not going to be just focused on gold and silver, but all commodities. And I know you've been nice enough to attend that and speak at that. So if investors who are listening want to meet you and I, that's a great place to do it. It's a wonderful hotel. It's 2 years old. I think it's going to be a great time at a really nice time of the year. So with that, I'm going to sign off and wish everyone the best until our next conversation next month. Thank you so much, guys.